Welcome back. I'm going to start today with a confession. For the first several years I paid serious attention to my finances, I did everything the right way. I read the stock reports, I watched the analyst segments on financial television, I researched individual companies, tracked earnings, and shifted my portfolio around when I thought the market was signaling something. I was, by every reasonable definition, a diligent, active, engaged investor. And my returns? Mediocre at best. Embarrassing when I'm being honest. You know what eventually beat every one of those painstaking years of active effort? Doing almost nothing, setting up a dead simple investment system, automating it, and then, and this is the key part, largely ignoring it. The less I did, the better I performed. And it turns out this is not some personal quirk of mine. It is one of the most replicated, most robust findings in all of modern financial research. The S&P Dow Jones SPIVA scorecard, the most comprehensive ongoing study of active fund performance, found that over a 20-year horizon, approximately 94% of actively managed U.S. large-cap equity funds underperformed a simple passive S&P 500 index fund. Not some of the time, over 20 years. More than 9 out of 10 professional fund managers with teams of analysts and billions of dollars of research infrastructure could not beat doing nothing. That is the premise of today's entire video. And I want you to sit with it for a second before we move on. The vast financial services industry, the fund managers, the stock pickers, the market timers, the analysts, exists to sell the idea that investing is complicated and requires constant expert attention. The data says the opposite. The laziest investment strategy, done consistently, beats the most actively managed approach the majority of the time. So today, we're going to build you a genuinely lazy investing system. One that takes about 2 hours to set up, maybe 2 hours a year to maintain, and has historically outperformed the overwhelming majority of active investors. Let's get into it. Chapter 1. Why laziness is actually the optimal strategy, the science. Before we get tactical, I want to spend a few minutes on why lazy investing works so well, because understanding the why is what gives you the conviction to stick with it when every financial headline is screaming at you to do something, and those headlines will come. They always do. Here's a phenomenon that financial researchers have documented thoroughly, and that anyone who has ever followed the news cycle while managing an investment portfolio will recognize immediately: the behavior gap. The behavior gap is the difference between the return an investment earns and the return the investor in that investment actually receives. How is it possible for an investor to earn less than their own investment? Simple. They make emotional decisions. They see the market drop 15% and panic sell. They hear about a hot sector and buy in at the top. They move to cash when uncertainty peaks, which is almost always exactly the wrong moment. Every one of those moves, with the best of intentions, chips away at the actual return they collect. Vanguard's ongoing research series, Quantifying Vanguard Advisor Alpha, and associated behavioral finance studies estimate that emotional investment decisions, panic selling, performance chasing, and poor rebalancing timing cost the average active investor between 1.5 and 3 percentage points of annual return compared to a simple buy and hold strategy in the same funds. Over a 30-year investing lifetime, that gap can represent the difference between a comfortable retirement and a financially stressed one. The lazy investor doesn't have this problem because the lazy investor isn't watching the daily fluctuations. They set up their system, automate their contributions, and go live their life. The market goes up? Great. The market goes down? Their automatic contribution this month just bought more shares at a discount. They never make a panic decision because they're not paying close enough attention to panic. This is not ignorance. This is one of the smartest behavioral hacks in all of personal finance. There's another reason lazy investing wins, and it's more mathematical than psychological. Fees. Every year you pay in investment management fees is a year of compound growth that doesn't happen, not just on the fee amount, but on every dollar of future growth that fee would have generated. Active funds typically charge between 0.5 and 1.5% in annual expense ratios. Some popular actively managed funds still charge above 1%. By contrast, a Vanguard or Fidelity index fund typically charges between 0.03 and 0.10%. The difference sounds tiny. It is not tiny. A landmark study by economist John Bogle, founder of Vanguard, and colleagues, widely referenced in academic finance literature, demonstrated that over a 30-year period, the difference between a 1% annual fee and a 0.05% annual fee on an initial $100,000 investment, assuming identical gross returns, results in a difference of over $200,000 in final portfolio value. The fee, compounded over decades, consumes a staggering portion of long-term wealth. This is money that goes to the fund manager, not to you. And given that the vast majority of those fund managers fail to outperform the index anyway, you are quite literally paying for underperformance. The lazy investing approach, which uses exclusively low-cost index funds, eliminates this drag almost entirely. You keep your returns. It's worth taking a moment to appreciate the intellectual legacy behind what we now call lazy investing. John Bogle, the founder of Vanguard, spent decades being ridiculed by the financial industry for his radical proposal that ordinary investors would be better served by simply owning the entire market at near zero cost than by paying anyone to pick stocks on their behalf. When Bogle launched the first index mutual fund available to retail investors in 1976, it was openly mocked on Wall Street as Bogle's folly. Nearly 45 years later, index funds manage over $15 trillion in assets globally, and the academic research has overwhelmingly vindicated his thesis. Research published in the Journal of Portfolio Management and widely cited in academic finance literature found that a passive index strategy, net of fees, outperforms the median active manager in virtually every asset class studied over periods of 10 years or longer. The longer the time horizon, the more decisive the advantage of the passive approach, largely because fees compound against active managers over time, just as returns compound in favor of passive investors. What Bogle understood, and what the lazy investor intuitively applies, is that the market's returns are available to everyone. The question is simply how much of those returns you give away in fees and how much you give away in bad behavioral decisions. Minimize both, and you win, not because you did something brilliant, but because you did almost nothing.
Chapter 2. The Lazy Investor's Toolkit. Everything you actually need. Okay. Let's talk about what the lazy investment system actually looks like in practice. I want to be very specific here because the beauty of this approach is in its simplicity. You don't need spreadsheets, you don't need stock picking software, you don't need to understand technical analysis or read earnings reports or watch financial television. Here's what you actually need. Tool number 1, a low-cost brokerage account. Your first tool is a brokerage account at a platform that offers zero commission trading and genuinely low-cost index funds. In 2026, the 3 most commonly recommended for this purpose are Fidelity, Charles Schwab, and Vanguard. All 3 offer zero account minimums, commission-free trading on index funds and ETFs, and their own proprietary index funds with expense ratios that are effectively negligible. If you want an even more hands-off experience, where the platform does the rebalancing and tax optimization for you automatically, a robo-advisor like Betterment or Wealthfront charges around 0.25% annually and removes every remaining active decision from the process. For someone who genuinely wants to think about investing as little as humanly possible, a robo-advisor with a sensible target date allocation is a completely legitimate and research-supported approach. The lazy rule. Pick one platform and open one account. Do not spread your money across 5 different apps because each one has a slightly different feature. Complexity is the enemy of the lazy strategy. One account, one login, done. Tool number 2.
The three-fund portfolio. If there is a single concept at the heart of lazy investing, it is the three-fund portfolio. Originally popularized on the Bogleheads investment community, a grassroots forum of index fund devotees inspired by Bogle's philosophy, the three-fund portfolio is exactly what it sounds like: your entire investment portfolio in three funds. 1. A U.S. total stock market index fund gives you exposure to essentially every publicly traded company in the United States, from large caps to small caps, across every sector. One fund, thousands of companies, maximum domestic diversification. 2. An international stock index fund gives you exposure to developed and emerging markets outside the U.S. This matters because the U.S. does not always lead global market returns, and international diversification smooths out the bumps over long periods. 3. A U.S. bond index fund provides stability and a counterweight to stock market volatility. Bonds typically hold their value or increase when stocks fall, cushioning your portfolio during downturns and giving you something to rebalance into when stocks are cheap. That's it, 3 funds. The specific allocation, how much goes into each, depends on your age, risk tolerance, and time horizon. A common starting framework is to hold your age as a percentage in bonds and the rest in stocks, split between U.S. and international. A 30-year-old might hold 30% bonds, 49% U.S. stocks, and 21% international. A 55-year-old might hold 55% bonds, 29% U.S. stocks, and 16% international. A comprehensive analysis published in the Financial Analysts Journal by researchers William Bernstein and others found that a 3-fund portfolio using low-cost index funds delivered risk-adjusted returns superior to more complex multi-fund strategies in the majority of simulated market scenarios, largely because the simplicity prevented the behavioral errors that more complex portfolios tend to invite. The key insight here is that more complexity does not mean more sophistication. A 12-fund portfolio with sector-specific ETFs, alternative assets, and tactical allocations is not smarter than a 3-fund portfolio. It's just busier. And busy investing, as we've established, tends to underperform lazy investing. Tool number 3. The target date fund, the ultimate one-decision portfolio. If even 3 funds sounds like too much work, and this is a judgment-free zone, that's literally the whole point of this video, there is a one-fund solution that is completely research-backed and used by millions of sophisticated investors: the target date fund. A target date fund is a single mutual fund that contains a diversified mix of stocks and bonds and automatically adjusts that mix over time, becoming more conservative as you approach retirement. You pick the fund whose year roughly matches your expected retirement year, say a 2055 fund if you plan to retire around 2055, and then you contribute to it and never change anything, ever. The fund manager rebalances automatically, the allocation shifts automatically, you do exactly nothing. And because these are index-based funds at providers like Vanguard, Fidelity, or Schwab, they charge expense ratios as low as 0.10%, essentially free. The Employee Benefit Research Institute found that Plum participants who invested exclusively in target date funds showed significantly better long-term portfolio outcomes than those who self-directed their allocations, primarily because target date fund investors made fewer reactive trading decisions during market volatility and maintained more consistent contribution patterns over time. The ultimate lazy portfolio. Open a Roth IRA at Fidelity, choose Fidelity Freedom Index 2025 or whichever year matches your retirement year, set up an automatic monthly contribution, never change it, check it once a year. That is the entire strategy. Chapter 3. Setting up the system. A one-afternoon project. Here's the beautiful thing about the lazy investing system. The setup takes roughly 1 afternoon. After that, your investment maintenance is maybe 30 minutes to an hour per year. Let me walk you through exactly what that afternoon looks like. Hour 1. Getting organized. The first thing you're going to do is get clear on two numbers: how much you can invest per month and what your approximate time horizon is. These two pieces of information determine everything else about your strategy. For how much to invest, the research is remarkably consistent. The specific amount matters far less than the consistency. Whether you can invest $50 per month or $500 per month, the most important thing is that the amount is automatic, regular, and genuinely sustainable without requiring willpower.
Behavioral economist Richard Thaler's research on present bias, our tendency to overvalue immediate rewards over future ones, explains why manual, intention-based savings consistently fails over time. His work, which earned a Nobel Prize in Economic Sciences in 2017, demonstrates that automatic, commitment-based savings mechanisms reliably produce higher savings rates than self-directed approaches because they remove the monthly decision point entirely. For time horizon, this is simply how many years until you expect to need the money. If you're 32 and saving for retirement at 65, your horizon is 33 years. If you're saving for a house down payment in 7 years, that's a 7-year horizon. The longer the horizon, the more equity, stocks, you can hold because you have time to ride out market downturns. Hour 2. Opening the account and setting up automation. Go to fidelity.com or schwab.com. Click Open an Account. For retirement savings, choose a Roth IRA if you have earned income and your income is within the eligibility limits. In 2026, the contribution limit is $7,000 per year or $8,000 if you're 50 or older. The Roth IRA's tax-free growth is one of the most powerful tools available to individual investors, and it is genuinely underutilized. Once the account is open and linked to your bank account, do the following. Select your fund. If you want truly zero maintenance, pick the target date index fund closest to your retirement year. If you want slightly more control, pick a total U.S. stock market index fund to start. You could always add international and bond funds later. Set up an automatic monthly investment. Choose an amount, set a date, ideally a day or two after your regular payday, make it automatic. This is the single most important action you will take in this entire process. Turn on dividend reinvestment if it isn't already on by default. This ensures any dividends your fund pays out are automatically reinvested, buying more shares. Over decades, reinvested dividends account for a substantial portion of total returns. Write down your login information somewhere secure, set the app to Do Not Disturb, and close the tab. You're done for the year. A study in the Journal of Finance examining over 60,000 brokerage accounts found that investors who traded most frequently underperformed the market by an average of 6.5 percentage points annually, while investors who traded least frequently came closest to capturing the full market return. The researchers' conclusion was explicit. Trading is hazardous to your wealth. The lazy investor's antidote to this hazard is the set-it-and-forget-it automation that removes the trading impulse entirely. Maintaining a lazy portfolio is about as demanding as a dental cleaning. Once a year, you schedule it, you do it, and then you forget about it until next year. Here's exactly what that annual check involves. Rebalancing. Check whether your portfolio has drifted significantly from your target allocation. If stocks had a great year, your equity percentage might now be higher than intended. Sell a little, buy a little bond fund, bring it back to target. If you're using a target date fund or robo-advisor, this happens automatically and you can skip this step entirely. Contribution increase. If your income has increased since last year, bump up your automatic monthly contribution. Even a small annual increase, $25 per month per year, can dramatically accelerate your portfolio growth over time without feeling painful in any given month. Life changes. If your timeline or risk tolerance has meaningfully changed, you got married, you have kids now, you're closer to retirement, make any necessary adjustments to your allocation. Otherwise, leave it alone. That is genuinely all there is to it. 1 afternoon to set up, 30 minutes per year to maintain. The rest of the time, your money is compounding quietly in the background while you live your life. This is not oversimplification. This is the approach advocated by index fund pioneer John Bogle, Nobel Prize winner Eugene Fama, Warren Buffett in his own will instructions for his family's trust, and decades of peer-reviewed financial research.
Warren Buffett, in his 2013 letter to Berkshire Hathaway shareholders, wrote that his instructions for the cash left to his wife's trust were to put 90% in a very low-cost S&P 500 index fund and 10% in short-term government bonds. I believe the trust's long-term results from this policy will be superior to those attained by most investors. This is the lazy portfolio, endorsed by arguably the most successful active investor in history. Chapter 4. The Lazy Investor's Enemies, What to Actively Avoid. The lazy investing strategy is simple to understand and even simpler to implement, but there are forces, some internal, some external, that are constantly working to pull you off the path. Let's name them directly so you can recognize and dismiss them when they show up. Enemy 1. Financial media and the illusion of urgency. Financial media exists to attract and hold attention. Attention is attracted and held by urgency, drama, and the feeling that something important is happening right now that you need to act on. This is structurally incompatible with a strategy built on patient inaction. Every breaking news segment about a market move, every analyst predicting a crash or a rally, every cover story about the hot new sector, all of it is designed to make you feel like you need to do something. As a lazy investor, your job is to recognize this for what it is and ignore it completely. A study by researchers at UC Davis analyzing over 60,000 brokerage accounts found that investors who traded most frequently underperformed the market by an average of 6.5 percentage points annually, while investors who traded least frequently came closest to capturing the full market return. The researchers' conclusion was explicit. Trading is hazardous to your wealth. The lazy investor's antidote to this hazard is the set-it-and-forget-it automation that removes the trading impulse entirely. Enemy 2. Stock tips and hot opportunities. At some point, probably multiple points, someone in your life is going to tell you about a stock that is absolutely going to explode. Their brother-in-law is in the industry, they've done the research, the fundamentals are incredible. This one is different. I want you to be genuinely kind to these people because they mean well, and I want you to smile and nod and then do absolutely nothing with your portfolio. Here's why. Research by Barber and Odine analyzed stock tip propagation, found that stocks receiving significant retail investor attention following tips or recommendations dramatically underperform the market over the subsequent 12 months, in part because by the time a stock tip reaches you, it has already been priced in by institutional investors with faster access to the information. You are not going to beat Goldman Sachs to a stock idea. You are not going to out-analyze a team of professionals who do nothing but research that one company 40 hours a week. And even if you somehow did identify a genuinely undervalued stock, the research shows that stock picking in a diversified portfolio rarely moves the needle in a way that justifies the time and risk. Your lazy index fund holds thousands of companies. One good pick in your portfolio barely registers. One bad pick, which is far more likely, can sting considerably. Enemy 4. Market timing temptation. The most seductive enemy of the lazy investor is the conviction during a market downturn that now is a good time to sell and wait for things to stabilize before buying back in. This conviction is almost always wrong, and the research is extraordinarily clear on this point. A study by Putnam Investments found that missing just the 10 best trading days of the S&P 500 over a 15-year period, days that are essentially impossible to predict in advance, reduced the overall return of the portfolio by more than half compared to an investor who stayed fully invested throughout the period. The best market days often immediately follow the worst ones, which means the investor trying to avoid the bad days also misses the recovery. The lazy investor's greatest advantage isn't their stock selection or their market insight. It's their willingness to sit still while everyone else is reacting. Every market downturn in history has eventually been followed by a recovery. Every single one. The investor who stayed in came out ahead of the one who moved to cash and waited for the right time to get back in. There is no right time. There is only time in the market. Enemy 4. lifestyle creep eating your contribution. This one's sneaky, and it's not about investing directly. It's about the contribution that feeds it. Lifestyle creep is the tendency to spending to rise in proportion to income, leaving the savings rate perpetually flat while income grows. You get a raise. Within a few months, your spending has risen to meet your new income, and nothing extra is actually reaching your investment account. The lazy investor's defense is simple. Every time your income increases, before you adjust your lifestyle, adjust your automatic investment contribution first. Even increasing your automatic contribution by just 1% of income with every raise ensures wealth building keeps pace with income growth, and behavioral research shows this approach encounters almost no resistance because the lifestyle never got a chance to inflate around the money. The Save More Tomorrow program, developed by Thaler and Benartzi, demonstrated that pre-committing to increase savings contributions with future raises before the raise arrives resulted in participants increasing their savings rates from an average of 3.5% to over 13% within 4 years, with essentially no reports of financial hardship. The key was that the contribution increase happened before spending patterns adjusted to the new income.
Chapter 5. The Long Game. What lazy investing actually produces over time. Let's talk numbers, because the lazy investing strategy's real power isn't visible in a single year, or even 5 years. It lives in the compounding that happens over decades, and the numbers at the end of that journey are worth understanding clearly before we close. Let's take a 25-year-old who sets up a lazy 3-fund portfolio today. They invest $300 per month, $3,600 per year, starting now. They hold a low-cost index fund averaging 8% annual returns. They make exactly 2 decisions in their entire investing career: the initial setup and incrementally raising their contribution by $25 per month every couple of years. They check their portfolio once a year. They never sell during downturns. They are, by every active investor standard, doing the absolute bare minimum. At 65, after 40 years, that portfolio is worth approximately $1,050,000 from $300 per month. $1 million generated by a strategy that required perhaps 10 total hours of active attention over 4 decades. Now, compare that to the active investor who spent those same 40 years researching stocks, paying 1% in fund fees, reacting to market news, and occasionally making emotional decisions during downturns. Accounting for the fee drag alone, 1% per year on a growing portfolio, the active investor's ending balance is roughly $200,000 to $300,000 lower. That's $250,000 given away in the belief that effort produces better results than patience. A comprehensive 30-year analysis by Morningstar, published in their annual Mind the Gap report, consistently finds that the average investor in actively managed funds earns significantly less than the fund's stated return due to the combination of fees, behavioral trading decisions, and performance chasing. The gap between what the fund earned and what the investor actually received averaged 1.7 percentage points per year across the study period. On a 30-year retirement savings journey, this gap represents hundreds of thousands of dollars in foregone wealth. The lazy investor doesn't have this gap because they're not moving in and out, because they're not paying high fees, because they're not making decisions based on monthly headlines. They are simply receiving, as completely as possible, the market's return, which, over long periods, has been remarkably generous to patient investors. Data from Ibbotson Associates and subsequent analyses of U.S. market returns show that the S&P 500 has delivered positive returns in approximately 75% of all calendar years since 1926, and over every 20-year rolling period in that same time frame, the index has never produced a negative return. The lazy investor who holds for decades is not gambling. They are participating in the most wealth-generating system in modern economic history, on its own terms, without trying to outsmart it.
I want to close by honoring the fact that calling this the lazy person's guide is a bit tongue-in-cheek, because what we've actually been describing is one of the most disciplined, research-backed, intellectually rigorous investment philosophies that exists. It just happens to require very little of your time once it's set up. Here is your action plan. All of it should be completable in a single afternoon. Choose your platform: Fidelity, Schwab, or Vanguard for self-directed accounts, Betterment or Wealthfront if you want a robo-advisor to handle everything automatically. Open one account, one login. That's it. Choose your account type. If you have earned income and are within income limits, open a Roth IRA. Contributions go in after tax, grow tax-free, and come out tax-free in retirement. It is one of the most powerful long-term wealth-building accounts available to individual investors. Choose your fund. For the purest lazy approach, a target date index fund matching your expected retirement year. For slightly more control, a U.S. total market index fund, an international index fund, and a bond index fund in proportions that reflect your time horizon. Set your automatic contribution, whatever you can genuinely sustain without straining your budget. Then commit to increasing it by a small fixed amount, even $10 or $25 per month, every time your income increases. Turn on dividend reinvestment. Enable automatic rebalancing if your platform offers it. Set a calendar reminder for one annual check-in. Then close the app. The rest of the year, live your life. Your money is working. You don't need to watch it work. The world will keep producing financial crises, market bubbles, analyst predictions, and hot stock tips. None of that is your business. Your business is your automatic contribution, your low-cost index fund, and your willingness to do almost nothing for a very long time. That patience, boring, quiet, deeply unsexy patience is the actual secret to wealth building that the financial industry has been charging you fees to distract you from for decades. Congratulations! You now know it. Do something lazy with it. Thanks for watching. If you found this useful, share it with the person in your life who is working too hard on their investments and getting too little for the effort. Like, subscribe, and drop a comment below. What does your lazy portfolio look like? I read every one. See you in the next one.